In the on-bound volatility research, we aim to discern the drivers of system volatility as it relates to bond release. Different parameterizations of bond release are studied to determine the main effect. So let's dive right in. In experiment 1, we see how the bonds of different release states, if they have different distribution of their value, how would that impact the system? So the simulations are generally run with normal parameters, and the bond scheduling is the change applied to in this experiment. There are 3 sets of different bond release schedules with the different ratios between the bonds, and then 2 levels of total face value. So you can see here, all the bonds have the same tenor of 30 days, but they start from 10, 30, and 50 days. So for these 3 bonds, the value between them could be 1 to 1 to 1, so even distribution, or 2 to 1 to 1, meaning the first bond released have double the amount of the other bonds, and 4 to 1 to 1, meaning a heavier front loading. And also we're changing the total value of these 3 bonds. So the median value will be 2 million and the large value will be 5 million. So that's the sum of all 3 bonds. And now let's see what's its impact from the simulation. So looking at the price volatility, which is relative to when there's no bond as a baseline. The front load amounts, meaning the ratio of the first released bonds, if it's bigger, we see the price volatility was also bigger. And also for the face value, if it's bigger, so meaning overall there's more own bonds being released, and there's more price volatility, which is pretty reasonable. And if we look at, did any of the simulation cause the pool to be drained because of the bond, we see, yeah, nothing happened. No pool has been drained. So we're gonna only focus on the price volatility for the rest of this analysis. So we want to ask, comparing the 2 factors of total face amount and the front loading distribution, which one is a bigger factor? So we do this decision tree analysis, and we can see that when the face value is smaller, that's a first important aspect. Smaller meaning the price volatility will be lower. And then you look into the front load amounts, when it's smaller, the price volatility will be even smaller. And that's true on the other side of the decision tree too. You can also do a random forest regression to just give you a feature importance. So here we can see that the face value is a bit more important than the front load amount. So to conclude, in this current setting, having bonds will increase the price volatility compared to no bonds. And the volatility is mainly driven by the face value, less so by the front load amount, meaning the uneven distribution of the different bonds. However, this conclusion is also constrained by the fact that we didn't use an overly large total face amount for all the bonds. So in the next experiment, we're going to address that too. In experiment 2, we have bonds of different tenors, and then we have different distribution between them. So here you can see they have the same starting date at the day 10, but the 3 bonds each have the tenure of 30, 60, and 90 days. So for these 3 bonds, we have an even distribution, 1 to 1 to 1 ratio, or 2 to 1 to 1. So the bond with the shorter tenor has the more face value. And then there's 4 to 1 to 1, a more tilted distribution. And then regarding the total face value, we kept the median of 2 million, large of 5 million, and extra large of 8 million, and see what would happen. So looking at the price volatility relative to no bond, we see a giant price volatility in the parameter setting of the 2 to 1 to 1 front load amount, and then a total face value of 8 million. And then relatively big is this 4 to 1 to 1 with the 8 million face value. If we look at that in the algorithmic scale, we can see when the face value is increasing, usually, yes, there's more price volatility as we've seen in experiment 1, 2. And there's bigger front load amount would cause bigger price volatility in general, except the last case where the total face amount is 8 million. So this might be a surprising observation that with a relatively high total face value, the medium level of front load actually shows higher volatility. But this, however, is an unfair representation of the data because all of the combinations with high front load amount and high face value are simulations that terminated early due to the pool draining. So here, looking at the KPI of pool draining probability, we see when the front load amount is 4 to 1 to 1 and the face value is 8 million, we see this rocking pool draining probability of 1, meaning all the simulations were predetermined because the pool has been drained. And my understanding is there's a huge bond being released that is the first bond with the shortest tenure. So we can also look into the max single bond value here, meaning among the 3 bonds, which one has the max single value and what's the value. And here we can see with this single bond of 5.3 million, the pool draining probability just skyrocket here. So we can just look into the simulation of this scenario when the total face value is 8 million and the front load amount is 4 to 1 to 1. And we can see the drainage happens when the bond is issued at the day 10. And we assume people pull a significant amount of ohm out of the liquidity pool to buy the bonds, causing the liquidity pool to drain. So this is indicating that this bond is too big for the pool depth, especially given now 3 bonds are issued at the same day. So that's a bigger impact too. So for the following analysis of the price volatility, we're gonna exclude this scenario when the total face value is extra large and only include the other more medium one. So looking at this decision tree analysis for price volatility, here again, we introduce this new way of seeing the bond parameters, this max single bond value as one of the parameter feeding to the machine learning algorithm. And we can see this is the most decisive parameter for the price volatility too, meaning when the max single bond value is smaller than certain amounts, and that will cause a smaller price volatility versus when it's higher, the price volatility will be also higher. We can also see that from the random forest regression analysis, that the max single bond value is the most determinant feature for the price volatility. So to conclude, in experiment 1, we explored different starting dates of different bonds and varying the face value of all the bonds. We found that the face value contributes more to the price volatility than the ratio of each bond's value distribution. The use of bonds overall will cause more price volatility than without any bond. In experiment 2, we explored different tenors of bonds with the same starting dates and the varying amount of total face value. And this time also adding more extreme ranges of the really high total bond face values. We found that for really high face values, it's much more likely to drain the pool, and in a more reasonable face value range. We also introduced the alternative feature of max single bond value, which actually predicts the price volatility really well. So for future studies, the following other factors could be looked into. First is the impact factor from bond to net flow. So here we're assuming a single parameter of how people are pulling ohm from the pool to buy bonds, then how when the bond expires, that's a certain ratio of that amount will go back to the liquidity pool. And these are extremely simplistic analysis that can be substantiated in the future. The second is the overall market activity volatility, so the randomization of the net flow. And third is contrasting the results with or without RBS and see if different parameterizations of RBS would impact this bond cost price volatility. So that's this ohm bond experiment.